Hello and welcome to Financial Markets Languish with Blake. I am obviously Blake, and today we're going to be going over some big financial news that's going to be upcoming in the near future. Today, Monday, February 13th, we had some earnings come out. One of the big ones after hours being Palantir, that obviously has caught a lot of attention from the recent meme, 2 year ago, meme stock rally, where they were one of the predominant names, and ever since then has been a name that's definitely been on the radar of a lot of people, myself included. I have no stake in this company, but definitely appears to be a company given a lot of attention, and for a right reason. They definitely have great pricing power. They have a model that they're able to continue to charge to companies at a higher and higher rate, hence pricing power. And not to mention the earnings that came in way exceeded expectations, and gives them a lot of right going forward. Not to mention just cybersecurity in general is a great field to be in, and obviously will continue to grow. Tomorrow we got big news in the morning, 8:30 a.m. Eastern Standard Time. We're going to have the CPI come out, the Consumer Price Index. This is a major thing that the Fed is watching, if not hands down at this current point, not the whole Fed rate hike cycle that we've been in, but right now, the PCI is definitely the most crucial information for gauging how much more we're going to need to raise rates before we can pause, and even potentially how close we are to this eventual Fed pivot. Lots of debates of people thinking how many more rate hikes we're going to have. Seems to be the general consensus that during the next meeting, we're at least going to get another 25. Potentially the meeting after that, we could get a 25. But already from the previous meeting, getting the 25, as opposed to the last couple where it was just 75, 75, 75, definitely shows that the Fed has realized we are near this market ending, and being near the end of this rate hike cycle definitely give markets a fresh breath of air, allowing them to rally ever since, the new year has hit. Because all of 2022, as just about anyone that's been remotely watching the markets has witnessed, has been quite a shit show. Obviously, historically, there's been much worse years, so if you're really going to say it's the worst at times, incorrect. But in modern history, definitely one to go down as being a bad year, given especially since practically, 2010, 2011, it's been almost a straight shoot up with just two little blips, one of them being the COVID blip, the next blip being the 2018 balance sheet removal blip, where the repo markets freaked out just due to the lack of liquidity in the markets. But now that we're on a better path, we can continue to keep going, and hopefully this rate hike cycle will end here soon. But it appears that this next CPI will give us a great breath of fresh air. A few things to look out for. This, even though we're in February, this will be the January, because obviously they can't compute all of February until February is over, and even still they need, time after the end of the month to be able to calculate that data. So in this next upcoming CPI report, what we're going to have is almost certainly an increase from December. Remember, it's January, the CPI we're going to be getting, even though it's February right now. But it's already predicted to be up month on month by 0.4%, which, if you annualized it, aka multiplied it by 12, because that's just a 1 month move, you'd be looking at a 4.8% inflation rate, which is obviously still well above what the Fed is hoping to target. They're hoping that inflation goes to around 2%, but, there could be a lot of flexible average targeting, which is essentially where, because ever since 2008, we've been on a free money cycle just due to inflation being low. It's been historically low and below 2%. They're looking for more of a balanced average. But take in mind, this has not been communicated through the Fed yet. This is mainly financial experts within the field. But there has been no communication that will be the case. And historically, that has never been the case. But with current economic information that has been given, it looks like this is almost certainly the best path forward. So they most likely will accept about like a 3, maybe a little over 3, as long as it's still trending down. That would probably be what most people would currently guess in the market would be an appropriate rate, cutting cycle to occur. But once again, no communication towards this, so who knows what really happens. And as far as other stuff we got on the calendar, we got plenty more earnings coming out. And these earnings, tomorrow at least, we got Coca-Cola in the morning. Big dividend stock, definitely makes up a lot of ETFs within the market and a lot of pension and type of stock that older folk would acquire. And when you get a very stable stock with a big move, that could obviously heavily spook the markets. But in this report, we're definitely predicting business as usual for Coke. And if there is a beat or a miss historically, it's not by much and doesn't have that big of a move on the stock just due to the clientele that tend to own it. In addition to that, we also have Airbnb reporting not before hours but after hours. And they're going to be a big one just to watch the consumer decline in the Q4. Obviously, historically, Q4 is a big travel month just due to Thanksgiving, Christmas, the holidays. People need to move, and because people are on the move, they need a place to stay where they're, going to be visiting family or going on a travel or have time off. Allows them to travel, so they would like to stay somewhere nice. Airbnb rates have just been up and up and up during this inflation cycle. So just to watch how much pricing power that the users on the site have, to see how they're able to convert that back into profits for the company, and to see if their margins decline, users decline, or prices decline, will definitely give us a lot of insight. Take in mind, CPI is coming in the morning, and that's obviously going to be much bigger, but that earning in particular is one that I'm heavily watching. In addition to Airbnb, we also have Marriott International reporting, and they're going to be big just to see the contrast in Airbnb. They're reporting in the morning in addition to Coke. In the evening, we have Suncor, another big oil company that will be reporting. And this company will definitely give us more insight. Obviously, we had the huge beat from ExxonMobil a week or two previous, and we predict the beats to continue. So we're more looking as the guidance. Obviously, oil prices are high. Oil companies are making historic profits, but it's all in the short term. Like any kind of cyclical commodity-based industry, it goes through cycles. Right now is a boom cycle, and almost everyone is in unilateral agreement that eventually oil will become a bust cycle again. The big disparity is how long it will be, and obviously getting a CEO that is in the field, on the day-to-day business, telling you when this will occur will give investors a lot more insight and be able to move forward. Another big company reporting tomorrow, also in the morning, just after CPI, is going to be Global Foundries. They're a big fab, means that they create they use the machinery to create CPUs, GPUs, and other processing units, which obviously is a huge part of the U.S. financial markets, when massively could impact stocks like AMD and NVIDIA that have been huge performers that have been my primary holding ever since I've started to invest, and continue to do great. But obviously this will give a lot of insight as to the current ebb. During 2020, 2021, chips were going through the roof. You couldn't even buy a GPU because miners were taking them all. There was just simply no way to get your hands on the type of gear that you needed to do what you needed without paying 5+ times the amount that you were paying before the pandemic. But now we're starting to see inventory gluts everywhere, lack of demand, and tons of units just due to the supply chains getting worked out, and because orders were so historic. Obviously a company is not going to want to sell their stuff to a scalper just to have them make the huge margin profit by reflipping it. They want to up their prices, but now they've lost a lot of that pricing power just due to the lack of demand, due to the cost of everything going up, and consumers just having less in their pocketbook to be able to spend on upgrading a machine, especially if they already have a computer or whatever type of equipment for their work that is already sufficient. Doing a big investment when prices are high and when you know they're coming down and when you know that, things are going to be better supply chain wise, better GDP economically in the future. It just is hard to invest on something that doesn't make an instant return right now. But obviously this will be changing soon, so good times ahead. Just keep looking forward. Thanks for this bird market update. We'll be watching the CPI closely tomorrow, and I hope to see you back again after the CPI where we can go over what happened and how to move forward. Markets today had a pretty decent rally going into the CPI. The Dow is up 1.11%, the S&P 500 ended the day at 1.14% up, and the NASDAQ ended the day up 1.48%, leading to a pretty good day. Definitely could have been a lot better, obviously, but by all metrics, a good day. Stocks dwindled a little bit in the after hours, but definitely, raised a lot of the fear from the huge volume that we've seen in options trading, betting on this CPI causing the markets to fall 10%. The amount of people that are betting on huge declines right now is definitely much higher than it has been, in the recent past. So definitely lots of fear among many investors going into this one due to the fact that the CPI is almost certainly, it's predicted to be up month on month compared to last month, but not by, that much, annualized, just 4.8%, not a whole lot in the big scheme of things.